Hello, good afternoon, and I want to welcome you to another time training. And this afternoon, we are looking at a summary of the training event we had at Abeokuta last week. So we're looking at understanding the basics of trading in the global financial market. And we said the global financial market is an online marketplace where the buying and selling of financial assets take place. Assets like currencies, like stocks, like indices and commodities. And this, depend heavily on the forces of demand and supply. And we also say that this market contains major participants that make the market to run smoothly. And this includes the institutional investors, the commercial banks, the brokers, the individuals, companies, and the central bank, each of them performing different functions. While the institutional investors have a large asset base, the commercial banks also take charge of keeping people's savings, and also have the brokers acting as an intermediary between the retail trader and the financial market. And the individuals trade independently in the market, and the companies contribute to the market with large volume transactions, while the central bank coordinates, the economy and other financial activities in the financial market. Now, we said that while this market is a global market, because all of us are not living in the same time zone, then the market, has been broken down into what we call market sessions. So, and there are three major market sessions: the Tokyo session, the London session, and the New York session. Now, the Tokyo session runs from 1 a.m. to 10 a.m., while the London session runs from 8 a.m. to 5 p.m., and the New York session runs from 1 p.m. to 10 p.m. in the night, all Nigerian local time. And we looked at the best time to trade Forex, and we say that this is actually dependent on the volatility. So we said that the best time to trade Forex is when there is generally volatility in the market. And this can be during a period we call market session overlap. That's the overlap between the Asian session and the London session by 8 a.m. to 10 a.m., or the overlap between the London session and the New York session by 1 p.m. to 5 p.m. The market tends to be very volatile during this period. Another time to trade is when you have a breakout, in the market, when the market has gotten to a level of being either overbought or oversold, and we expect a reversal in the market. That can be a time to also trade the Forex market. And the third best time is during fundamental release, when there is fundamental news which is released. Such period can be very volatile and can give a lot of trading opportunities. And finally, we have the best days of the week to trade, which is Tuesdays, Wednesdays, and Thursdays. And just a little recap also on each arm of the global financial market. Like we have the currency markets, where the dollar is the most traded currency, and that accounts, the dollar accounts for about 87.6% of all transactions, generally in the Forex market. We have the commodities market, which is made up of three parts: the energy sector, the metals, and the agricultural produce. Under the energy sector, we have the natural gas, we have crude oil, we have heating oil, and unleaded gas. And under the metals, we have gold, copper, aluminum, silver, nickel, and zinc. And for the agricultural produce, we have a myriad of agricultural products like soybeans, coffee, sugar, live cattle, and so on and so forth. And we said the indices market is made up of different indices of different stocks rather of different sectors of the economy. Like in the United States, the NASDAQ is made up of stocks of technology companies. So each country has its own index. And finally, we have the cryptocurrency market, which is an offshoot of the global recession that happened between the year 2007 and 2008. And then, most dominant cryptocurrency today is actually the Bitcoin, and many others have come after that. Now, we also say that when you're trading currencies, trading is done in pairs. You trade currencies as a pair. There's no Forex trading where currencies are traded as an independent currency. In fact, from the word Forex trading, it means the exchange of one currency for another, meaning you're exchanging probably local currency for a foreign currency, just an exchange between one currency and the other. That's what Forex trading is all about. And there are different categories of currency pairs. There are 3 in number. We have the major currency pairs, the cross-currency pairs, and the exotic currency pairs. Now, the major currency pairs are made up of by merging the currencies of countries with big economy, in the world, with the dollar. That gives us the major currency pair. Like we have the Euro USD, the USD JPY, GBP USD, USD CHF, USD CAD, AED USD, and New Zealand USD. I would say that a lot of newbies are favorable to trading this because, one, the spread on these major currencies is very, very minimal. And secondly, they are not too volatile. They are easy to trade for new traders. And thirdly, they are very liquid. Many people around the world trade these currencies. And we mentioned the cross-currency pairs has been formed whenever you merge 2 major currency pairs together without the dollar. For example, if you merge Euro and Japanese yen together, that's a Euro cross. When you merge the pound and the Swiss franc together, that's GBP CHF, that's a cross currency pair. And the exotic currency pairs, like we said, they are made up by merging any of the major currencies, either dollar or pound or euro, with the currency of an emerging economy. Emerging economy like Brazil, like Mexico, Chile, Turkey, and South Africa. And we say that these emerging economies rather, they are the ones that make up what we call the BRICS. That's the group that is trying to question why the dollar is the dominant currency in the financial market generally. So merging any of these currencies together with the major currencies will give us what we call the exotic currency pairs. Now, these exotic currency pairs, they can be extremely volatile and comes with a very wide spread. In fact, the spread can be wider than that of the cross currency pairs. And we looked at the most actively traded currencies, and we said that the Euro USD is the most actively traded currency in the forex market, followed by the USD JPY and the GBP USD. And the major things you need to trade the forex market, number one, you need a personal computer or a tablet or a phone. Now, it's not mandatory to have a laptop if you don't have one, but if you have one, it can be good. It can be an asset to this business. And secondly, you need a stable and high-speed internet connection. And also you need your trading capital, your equity, which should be a reasonable one, and also a reliable forex brokerage like PUPRIME, for you to trade on their platform. And we also said that in this business, generally in the financial market, what we're doing is that we're buying assets low and we're selling at a high price. So if the price of a currency comes down, it can be an indication or an opportunity to buy. And as the price appreciates, you can get to a point where you want to sell and you've made your profit from that transaction. And we looked at 3 things we need to know that helps us as we start to trade. And the first is called the entry price. This is the price at which you start a transaction, you start a trade, followed by stop loss. As we said, that stop loss is you telling your broker how much you are willing to risk with your trade. And the take profit is you telling your broker how much you are willing to make as profit with one trade and close it once you are happy with the amount. And we say the entry price is the price at which you execute your trade, either a buy or a sell. All right, so that's the summary of the first module of our training. Then I'll proceed to the second one. And here we're going to be looking at the major terminologies in forex trading. Now, it's not an exhaustive list. It's just something to get started as a new trader. And the first one we want to look at is the base and quote currency in trading. And we say that a currency pair is a combination of 2 different currencies that are quoted against each other. So the first currency in the pair is called the base currency. For example, here we have the euro and USD, where the euro is the base currency and the dollar is called the quote or the counter currency. And we'll look at the other terminology, which is the bid price and the ask price. And we say that the bid price is the trader's selling price, while the ask price is the trader's buying price. And we say that the bid price is usually lower than the ask price. And the difference between the bid price and the ask price actually gives us what is called the spread. And people said it means price interest point. And we say pips is an increment or decrement from one price point to the other. So when price goes up, we say it moves up by X amount of pips. And when it comes down, we say it has dropped by an X amount of pips. Also, we look at lot size, which we also call trading volume. So we say that trading is done in specific units called lots, and lot size is what measures the percentage of your capital you use per trade, which in turn determines your profit or loss on that trade. And there are three types of lot size. We have the standard lot size, the mini lot size, and the micro lot size. And we said that for the standard lot size, 1 pip is valued at $10. For the mini lot size, 1 pip, the mini lot size is represented as 0.1 lot. 1 pip is valued at $1. And for the micro lot size, represented as 0.01, 1 pip is valued at 10 cents. And we also showed us the recommended lot size table, which we're seeing currently. And we said that for an account size of $10,000, the maximum lot size to trade, the recommended lot size rather, on that account should be 1 standard lot. And for a $1,000 account, the recommended lot size is a 0.1 lot or the mini lot. And for any account less than $300, we said the recommended lot size is 0.01 lot, which is a micro lot. We also looked at leverage, where we said that leverage is the ability to use a small amount to control a way bigger amount, of funds. And we said there are different levels of leverage on the platform, but we recommend you can use leverage 1 to 500. And finally, we looked at the third module where we talked about candlestick pattern. I would say that the candlestick itself was originated by Japanese rice merchants, and as over time, it has been adopted into the financial market to determine price movement in this market. And we said the candlestick is made up of 4 parts. We have the high, the open price, the low price, the high price, and the close. Now, the major parts of the candlestick is called the real body, while we have the upper and the lower shadow. The first candlestick pattern we looked at is called the hammer. And we said the hammer is formed in a downtrend, when price is in a downtrend, and it gets to a point where the buyers try to overcome the sellers by pushing the price up. So we say a hammer is a candlestick pattern formed when a short body and longer wick or shadow is found at the bottom of a downtrend. And we also said that confirmation for a bullish trade happens after you have sighted a bullish candle immediately after the hammer. So you need to wait for that bullish candle to open and close, then can trigger a buy afterwards, because we already have a confirmation of a reversal in price. And here we have an example of that, how price trended downwards. We found a hammer, the next candle, a bullish candle, after which the price continued going in the bullish direction. And next we have the shooting star, which is formed at the top of an uptrend and will require a bearish candle afterwards as a confirmation before triggering a trade in the bearish direction. Just like the hammer, it is made up of a candle with a long shadow and small body was usually found at the top of an uptrend and leads to a bearish reversal in the market. And here's an example of a shooting star where price, a shooting star was formed, a bearish candle was found, after which price began to trend downwards. Then we looked at the bullish engulfing pattern, which is also formed in a bearish trend, and it consists of a small bearish candle, and the next candle to it is a bigger candle that overshadows or engulfs on the previously smaller bearish candle. So this is an indication that the buyers have been able to, push the market in the in the bullish direction. So it's a bullish reversal pattern. And here's an example of the bullish engulfing pattern where we saw price trending downwards, and we have a big bullish candle beside a smaller bearish candle, and the price and the market reversed completely into the bullish direction afterwards. And also we have the bearish engulfing pattern that forms in an uptrend, and it comprises of a bullish candle followed by a bigger and longer bearish candle, and we can see the market goes into the bearish direction afterwards. And finally, we have the doji, and we see that the doji is an indecision candle, which, if found at the top of an uptrend, can signal a reversal into the downtrend, and if found in the downtrend, can signal a bullish reversal. And there are 4 types of doji in this diagram here. We have the regular doji, the long-legged doji, the dragonfly doji, and the greystone doji. And what is common about them all is that the open price is equal to the close price. So usually the doji is represented as a candlestick with no serious body, an upper shadow, and possibly a lower shadow. And in the case of the greystone doji, there is no lower shadow, just a long upper shadow. And finally, we looked at the trading softwares from PUPRIME's educational department, and we looked at 2. And the first is the PU Profit Scanner, and it comprises of several indicators where basically all what you are going to be doing is looking at, a confirmation of alignment, the point where all the indicators align either in the bullish or the bearish direction. A scenario where you have all the indicators turn red, that's after a red or pink arrow has pointed downwards, and you have all red on the indicator signifies a bearish movement, in the market, like in this scenario here. And on the other hand, when you have part of some of the indicators after a green, or a slightly blue candle has appeared, and we have all the other indicators turn either blue or green, indicates a bullish movement in the market using this indicator to generate signals. And finally, we looked at the PU Morning Coffee, which is a scalping software used to trade the London break session early in the morning. And there's a dashboard that shows you trend on different time frames, and we equally have the breakout box, and also, which the basic idea is that early in the morning, the price breaks out, above a ranging zone that has happened overnight due to the night session. Then as a London session and the Asian session overlap, there's volatility in the market, pushing the price either in the upside or the downside direction, which you can use this software to track the movement and also to make profit. All right, so that's all we've done at the seminar at Abeokuta. Just watch this video. You can watch it as many times as possible to get an understanding of how the market works. All right, so we'll drop more videos in due course. Take care and bye for now.